Welcome everyone to tonight's Hook Up with Real Estate Masterclass. We have a very special guest, Aaron Kancevicius. Nothing like it's spelled there, but that's how you say it. And we'll introduce him in just a minute. But first, Ken, would you mind reading the disclaimer?
Yes, we appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, tax, or investment advice. Nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hook Up with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you can consent to this event being recorded and understand that internet security is not absolute.
Thank you. All right. That was Ken. I'm Donna, and our mission is to empower aspiring and early real estate investors with exceptional education and valuable skills and genuine opportunities to invest in real estate while sharing strategies that guide you toward success and away from the costly mistakes that we made as beginner real estate investors, which you can read in the book, Real Women in Real Estate. Yeah, and Aaron, you will get your very own copy. So just briefly, Ken is a licensed realtor, also a real estate investor, a tile contractor, and a veteran. And if you're in the northern New Jersey area or need a referral from this area or to this area, you can contact him at Kenneth-Hook at .weichert.com. We are powered by Legends Equity Group. This is one of our multifamily properties in Las Vegas, and we also are involved in triple net industrial flex. Right now, we're doing a market analysis in Indianapolis, and this is just for educational purposes, not intending to sell anything, but Indianapolis is a premier logistics hub. It's around a lot of highways, and it's one of the world's busiest cargo airports. It has strong rail connections, numerous distribution centers, and this transportation network creates a demand for warehouse space, particularly industrial flex, shallow bay. And then it also has a diverse tenant base with multiple industries there: medical, pharmaceutical, auto supply, HVAC, electric, plumbing, et cetera, et cetera, et cetera. You can read that. Okay, so we also own single family houses in Indiana. So, just expanding into commercial is quite normal there. There are two ways to connect with us, and we encourage you to subscribe to our YouTube channel, which is on YouTube at Hook Up with Real Estate, and we have a Facebook page, groups with an S, Hook Up with Real Estate. All right. And if you're curious, about how we can help you deliver on real guidance, real strategies, and real opportunities, you can book a strategy call with us. And also, this is our calendar for the year. In July, we have quite a few. I already have all of our guest speakers lined up for the rest of the year, which is kind of rare, so I'm excited about that too. Generally the fourth Wednesday, except November and December to avoid holiday confusion. All right, Ken. Can you please read this quote of the day?
Yes, if you want to build wealth, first build a wealth of knowledge. Jeffrey Gitomer.
Yeah, Gitomer is this marketing guy. All right. Well, now we get to the good stuff. All right. I am going to introduce Aaron, K for short, or Kancevicius. All right. Aaron is a 1031 exchange expert and the vice president of business development for the company called 1031 Specialist. He's been featured on impressive podcasts, including Cash Flow Quest with Comfort Capital and Anderson Advisors with Esquire Clint Coons. And that is where I first heard Aaron speak. We were looking for a 1031 specialist, and Aaron's knowledge absolutely blew me away. Like I had interviewed other people and it was just like mediocre. And I'm like, whoa, this guy really knows his stuff. So I set up a discovery call with him. And right then and there, I knew he was a person for our 1031 exchange, which he and his company successfully helped us close last November. Aaron's also an instructor at San Diego Association of Realtors, and he speaks on stage at the National Association of Real Estate conferences. And additionally, the National Association of Realtors, NARS for short, he trains them in mastering 1031 exchanges, and he's the only qualified intermediary backed by the NARD Reach program, which is a highly selective real estate technology accelerator. So we are super excited to have Aaron Kancevicius here to share his insights on building wealth with 1031 exchanges. I'll stop sharing and I'll say thank you
Thank you.
for joining
Thank you.
us. And we always ask the first question, how did you get started in real estate? Or 1031s for that matter.
For that matter, yeah. Took the roundabout path. So, yeah, good question. Long time ago. So, it's going on about 30 years now. Actually, so I started in the loan business. Um, and those were in the days where it was actually with a finance company, um, doing like personal loans, equity loans, different home loans. And it was right around the time subprime was just starting. And I like to say that's before subprime was a dirty word. Those were just the first times they had, stated income programs. But they still had, you had to have qualifying LTVs and different things before it went wild. But that was the start, was in the loan field. And then we're from Northern California, actually. We moved to Hawaii, and I joined a mortgage company there, and became to have vested interest in the company. But education, I guess, was always in my blood. Even back then, I would go do speaking engagements at different real estate offices. One of the largest ones, or actually it was the largest one at the time in Honolulu, Abley Realty, had me come back in regularly once a month to train all their new agents. He was recruiting all the time. And I had like a 2-hour course that I trained every month on real estate finance. So I've been teaching real estate finance for almost 30 years. And what happened is 11 years ago we moved here to San Diego, and I set up. There was a local qualified intermediary, so that's what you call a 1031 exchange company. By the way, they go by QI for short, or exchange accommodator. But they were they were realizing they had all these exchangers, selling, and then they had to buy, and they needed loans. And I actually went in there and set up a mortgage company inside this 1031 QI company. And but as it would go, of course, because of my background and experience, they started having me talk to the clients more and more about the exchanges. So I started advising more and more. And this was in an attorney-owned company, so I was attorney mentored and became the lead advisor. That company had since sold, but that was right here in Carlsbad, as you had mentioned. I think your daughter's nearby. But anyway, he sold and needed to retire, and I was out actually about ready to start up my own 1031 company when I kind of crossed paths with 1031 specialists, and that's where I'm at now today, advising and educating.
That's terrific.
Great.
And they're a great company, by the way. really soup to nuts. Everything you need is there.
We appreciate that. Yeah, we appreciate that. And thanks for mentioning that. And I'm really impressed with how you've learned my last name, by the way. So good job on that. I'll take Aaron K. Is just fine, but yeah, you're doing great.
Okay, so do you want to share your presentation now?
Yeah, so let me share my screen here first and hit share. Let me pull up the right one. Yeah, whoops, almost there. I just got to make a presenter view. Okay, so you should have that on your screens. And yeah, so we're calling this building wealth through 1031 exchanges and how that works. I'm sure with your audience, some uh, they may be brand new to exchanges. I think the majority might at least kind of know what an exchange is. There's usually some that are brand new, and so I intend to cover the basics and give some strategies along the way. I do a lot of teaching and educating, whether it's webinars like this all around the country. Um, I do a lot of classes right inside real estate offices here locally. I teach at the Association of Realtors because education's really been missing with the ins and outs, which is understandable because it's not what investors do every single day, like we do. So that's what I'm here for. All my information, by the way, is here in this QR code. I can save me on your phone because you may not have a question now, but 6 months from now, something will come up and you can feel free to email or call or text anytime. But I just gave you a little of my background. So yeah, so I've advised now on exchanges anywhere from 100,000 to 100 million. We partner up with a lot of different brokerage offices, CPAs, financial planning offices, attorneys' offices, just to be consulting and educating all the time. And I thought I'd just mention first a little bit about 1031 specialists also. We are a national company. So I do exchanges in all 50 states, done a ton where you're at New Jersey, New York, a lot on the East Coast, all the way out to Hawaii. One of our partners is a global banker company that's all throughout the islands in Hawaii. And I have the rough task of doing business trips out there to run trainings for their offices. So that's all part of my deal as well. But yeah, so we're always here to consult. That's what we're all about. You mentioned in our Reach program, that's because of how we streamline the process, why we're all about education for both the investors and brokers, and also our very transparent fee structure. We have a feedback guarantee, but that's more advertising for the company. But let's get into some things about exchanges now. I always call, first of all, I always call 1031 exchanges as the biggest gift that the U.S. government has given taxpayers and it's not even close. You would think everybody'd be doing them, all the time, but the reality is when we look at just the numbers, there's no specific statistics I can point to. We're just trying to always kind of look at numbers, how much is sold, how much is exchanged. It looks like about 1 in 6 or 1 in 7 properties that could be exchanged are actually doing exchanges. And when I just do quick, basic math, this may be close to, it's not spot on, but it looks like probably right around $18 billion in unnecessary tax being paid when that's the case. And so we think with more education, we think a lot of that, and it's because of my conversations that I have every single day with both investors and brokers. A lot of it's due to myths, misconceptions, misunderstandings, and so we feel by doing all this education, hopefully, we think that should come down to 1 out of 2. But even if it came down to 1 out of 3 or 1 out of 4, that's still a huge savings, a lot more money in people's pockets. And again, for those that are brand new to exchanges, why are we talking about this? It's because every time you sell a property, you're going to trigger a tax bill, and you can get all around that when you're doing investment property with a 1031 exchange. And I'll break that down. But this is just kind of the numbers that I'm seeing, and this is why I'm out there all the time doing this, is to try to get this number down. Okay, so And with this too, I usually do run like 30-minute courses at local offices, kind of like a lunch and learn type of thing. So I've added more on here. I'm going to go through basics. I'll go through a few more detailed things, and we'll have plenty of time for question and answer. And again, I'm always available as well. But first of all, just to start from the very beginning, as I mentioned, anytime you sell property, that's when you trigger a tax bill. Um, and it can be quite large. And I'm going to break some of that down as to what that can come to and how. But the IRS gives you this regulation. It's Section 1031 of the IRS tax bill that allows ones that are selling investment property, if they're going to put it into more investment property, they can defer 100% of that tax, that capital gains that they would have been paying normally. And so that's all that money then, instead of going off and they have to kind of start, they drop back 40% and then they have to start over again. They can keep all of it compounding and compounding and compounding and growing and growing and growing. And I have a chart that'll show that. But it's not, here's the thing, it's some think it's like this hidden secret, but anybody can use it. Wealthy families for generations have been the ones using it. And that's how this generational wealth has been transferred through these different, families. But it's been in there over 100 years. It's not a loophole at all, so to speak. It's very straightforward. There's just some rules around it. And what I like to kind of say about it is to think in terms of, if you're preparing your tax returns in April and you realize you owe the government $200,000. And instead of sending them a check, you thought, I'm going to ask them, what if I send a note saying, dear government, I know I owe you a ton of money, but what if I kept that money myself so I can reinvest it into myself? I think that'd be better. And what if the government says, yeah, that sounds great. Go ahead and keep it and reinvest. We think that would never happen. But that's essentially what a 1031 is doing. The difference is you can't wait until you're filing your tax returns to do it. It has to be done at the sale. So that's the first thing I'm going to go through, is the basic timeline of around it, how it works. And there's these three different types of exchanges. I'm going to spend a lot of time on this forward exchange. This is when someone's selling property first, then they're going to buy next, because this is by far and away the majority of exchanges that are done. So what happens is you're thinking about selling an investment property. You have appreciation, there's gain in it, and you're going to get hit with a bill. So you're thinking, okay, I'm going to sell this investment property. I'm going to put it into another property that maybe has better cash flow, is in a better location, has more, an area of more appreciation, or maybe put it into two properties, and start multiplying properties, whatever it might be. So from the day that you sell that property, here, that's this day zero. That's your timeline starts. And then to finish that up, every exchange is 180 days long. So that means you sold on day zero, you have to be done purchasing by day 180, and it's all done. If you haven't made any purchases by day 180, it's over. Okay, you're just going to report your sale and pay. So that's pretty straightforward. Now, there's this 45-day part on the timeline that can come up kind of quick. This is to identify replacement properties. So what that means is, if you haven't purchased your replacement property yet, well, then on day 45, you have to turn in a list of potential properties. And after day 45, whatever you close on has to be something that's on that list. Okay, so it's just the IRS's way. Way in the past, when these first started, there were more like simultaneous exchanges, like swaps. Like, hey, I have a property I want to sell. You want my property, I want your property. The IRS would let you literally exchange with somebody else. And so this has grown and adapted since then. And this is the IRS's way of doing that. They're saying, okay, but you can do this, but we still want to keep you kind of on a little bit of a leash and a time frame to get it done in. So that's how they do it. So day 45 is the identification time. A lot of people get that confused when they first consult with them. They're thinking it's 60 or 90 days. No, it's 45, and it's always been 45. You have to plan for that. The other part of this is, so first of all, when you Google anything about 1031 exchanges, you're going to see those two timelines, 45 and 180. I really call this day zero the third timeline. Because now that's the day you close on your sale and ownership is transferred, but it has to all be set up before that. Okay. So even though the timeline hasn't started, it has to be ready to go before that happens. And the reason I highlight that is when somebody looks at this online, when they're just kind of researching 1031s, I get these kind of phone calls. They'll say, like today's near the end of July, they'll say, I sold a property in May or June, and it looks like I've been researching this. Looks like I have 180 days to complete an exchange. So I want to do that. What do I have to do? And I have to tell them, well, since you already sold, it's too late to set it up and do an exchange. You're going to have to report that and pay the tax, or have your CPA get creative about other write-offs. Because it has to all be set up at the closing. We're on the settlement statement. We hold the funds. There's paperwork that's done. So it's a vital thing that keeps getting missed. Okay, so that's the general timeline, first of all, in an exchange. You'll see these others, and actually later I'll mention a little more detail about a reverse. So you could do all this in reverse. If you have your perfect replacement property that you don't want to miss, or you don't want to deal with this 45-day window, you could buy your replacement property first, and then you have the whole 180 days to sell. There's more to it to that, so I'll have a couple slides later. There's also an improvement exchange. So if someone's buying a replacement property and there's going to be funds left over in their exchange account that they would like to use towards rehabbing that property instead of paying the tax on those leftover funds, that can be set up as well. Again, there's more to it to that. That one, I'd say just, if you're ever thinking that that's going to be the case, please talk to us well in advance. So that we can go over all the details and the numbers. That there's more time set up, there's more cost. Okay. Okay, so those are the basics on the types of exchanges, and then there's really only a couple of key differences regarding that setup I was referring to. So number one, the IRS requires the use of a qualified intermediary, actually. So if you want to do a 1031 exchange, you need a qualified intermediary, a neutral third party. Now we as a company, we operate as that. There are other companies, but that is what we do. We facilitate exchanges, and it's not really going to alter your real estate transaction much at all. In other words, it's not going to delay your transaction. It's not like a loan where we have to underwrite for a couple of weeks and get approval. No, it can all be set up very quickly. But what's happening is basically this is just showing, let's say you have two properties. So this one you're going to sell or relinquish, this one you're going to buy, this is your replacement property. And we just come right in between. So once you're under contract, we come right in here, we set up our paperwork, we set up an account to hold the funds. And then when you go to close on your replacement property, we transfer those funds there with your authorization. And that's basically it. Now, the reason we have to hold the funds is if you as an investor were to not set up an exchange and you're sent those proceeds, once you come into contact with them, that's constructive receipt of the funds, you're going to pay the tax. So again, vital to do this ahead of time. And then there's a lot of reasons why you would even want to consult and go over all the numbers when you first start thinking about selling, as I'll get into, as you'll see as we go through different scenarios and things. But the actual act of setting it up doesn't take long. Okay. So that's kind of the general, the gist. Now I mentioned,
Aaron, just to your point, going back to the other side. So I think I might have talked to Aaron a couple of times because we had a false sale, right? We thought we were going to sell and then we didn't sell. So, we're holding off doing the 1031, signing up until we had confirmation. And then when we got the new sale, that's when we signed on. So, you want to watch when you sign up too, right? Or can you talk
Yeah,
about
and
that?
there's no harm. I mean, that happens. That's part of real estate, right? Things, fall out. They're under contract and then they're not. There's contingencies we got to pass, but we look at it as, I mean, there's no harm in just having it ready. If it falls out, that's fine. Uh, there's no cost or no charge until it actually closes. But yeah, and you saw that. That's what we went through. We'd say, okay, we got it ready. Oh, no, it's not quite ready. And yeah, and that's common, right? That's real estate.
Yeah, real estate.
The, the main thing is just not waiting till the last minute. Now we can set it up at the last minute. I mean, but what happens is, does everybody just, get us everything that we need to do that? And also when I consult with sellers, if they're consulting at the last minute and if they have misconceptions about some of the rules or myths or plans of what they thought they were going to do, it's kind of late in the game for them to change those plans. So that's the only thing. So I let people know, hey, if you forgot to set it up and you're about to close tomorrow, call us. We'll get it set up. Not a problem. But what we prefer, if at all possible, talk to us ahead of time. Now, okay, so now this 45-day thing, I mentioned identify. What does that mean? So there's a couple rules regarding that, and that's what I was going to touch on here next. And again, most that have either done an exchange or researched this, they hear that that you can identify 3 properties. Now you can identify different amounts, but here's the thing: there's rules set up by the IRS. So the reason you usually hear identifying 3 properties is there's no limit to the total value of all the properties. So if you sell for $1 million, you can list 3 properties and the total value can be 100 million. Doesn't matter. And by identify on a list, literally as part of your exchange paperwork, we provide you a list, the 45-day identification list that says, put out your address that you're thinking of and the approximate value, and do that for each property that you're thinking of. So what happens if you identify over 3 of them? So 4 or more, they have this 200% rule. So what that means, okay, so if you have 4 or more, now we got to add up all those values on the list. And if it equals, or if it's more than 200% of what you sold, it's not going to be allowable by the IRS. So basically, it can be double the amount you sold. So if you sell for $1 million and you listing more than 3, well, then you're going to be capped at 2 million of the total values. All right. And you can kind of see from that, like if you're trying to replace it with one property, and I'm going to get into replacements here in a little bit, but if somebody's selling for $1 million and they're buying for $1 million, they're going to just stick to the 3 because of the total values. But if they're going to replace with a bunch of smaller properties, which is common, maybe they're selling for $1 million and they're buying for 300,000. Yeah, they can list, like 6 of them. There's this 95% rule. That means if somebody listed more than 4 and all the values are over 200%, then they're going to have to buy 95%. Basically, this is a list, they're buying all of them. So it's very rare. There are specific situations where that happens. But I just thought I'd mention that because that's usually one of the first questions. How many can I identify? And again, this list is not due until day 45. So before that, you can write offers on 20 properties. That's totally fine. I like to mention that because that's a little bit of wiggle room that somebody could do. Okay, so let's get into why this is so important. And I mentioned, only about 1 out of 6 or 1 out of 7 properties are being exchanged. Again, I find a lot of that due to misconceptions people have because they're usually Googling 1031 exchange or chat GPTing it, and they're getting not the whole picture. The first thing that I see is not understanding the tax hit that someone's going to have if they don't exchange. A lot of people are selling and you ask them, are you exchanging? They say, no, I'm just cashing out. Okay, they understand the full tax bill, or are you just expecting, maybe to pay a few $1,000s and walk away with a ton of money? And if I ask most investors or just most people in general, what do you think the capital gains tax is? What's the tax rate? Guess what most are going to say? First thing that comes to their mind is 15%. And that's because when they Google what's the capital gains tax rate, that's what comes up. Well, that's the federal tax rate. And so I put together this list here that's only one of several layers to the tax equation here. So 15% is the federal rate. Now, actually, it can be up to 20, and it's based on income. So higher income earners, and I believe for two people, that's a little over 500,000, something like that, would be at the 20% rate. So it all depends. But so 15 to 20%, that's just federal. Then they're forgetting that the state is also going to have capital gains tax. There are a couple states, Florida, Texas, that are at zero, all the way up into my lovely state of California, the highest, 13.3, and then they're all in between. So it's important though to figure, to know that, to know what your state is that you're selling in. Investment income tax, again, for those high income earners, because they make more, they're going to get hit with another 3.8%. Now, the one that everybody forgets about, or either forgets or just was never even aware of it, is this depreciation recapture. So think of this now. One of the great reasons to have investment property is every year you're getting this, I call it like a phantom loss. It's depreciation, that paper loss, right, coming off your return. Or now with bonus depreciation is back. Somebody could buy a property and depreciate the whole thing in year one and offset other gains. But here's the thing: if you sell a property and you're not going to exchange, well, then the IRS wants 25% of all depreciation that's been taken. They want that back. So it's called depreciation recapture, 25%. So now when you add all of this up, you're not at 15%. You're usually somewhere around 30 to 40%, depending on your state and how much depreciation you've taken. And that's of the gain. Okay. So let's just go through what we're talking about when we talk about capital gain. Number one, how much money you're getting out of the sale, your proceeds, is no part of the equation. Okay, so in other words, your mortgage balance is not part of it. The only thing that's part of it is your allowable closing costs, so commissions, any title fees, things like that. So if somebody's selling for $1 million, and let's say 5% are their closing costs, they have a net sales price of 950,000. So in this example, and I'm breaking this down a little more than I usually do, but it's because new investors they have to really understand what we're talking about with capital gain. Let's say they bought this property for 500,000. Well, initially that is your tax basis. So anything over 500,000 would be your gain. Maybe you put in 50,000 in capital improvements. Okay, that can be added to your tax basis. Okay, so but again, if you have depreciation because you've had this for a few years, that's going to add to your gain now that you have. So in this case, their whole capital gain is 600,000. So it doesn't matter if their loan amount is 800,000 or 100,000 in this instance. Their gain is 600,000, and that's what they're going to get taxed on. Okay. And I'm going to talk a little bit more about loans and mortgages and how this is all affected.
So even if you purchase for 500,000, you're still gonna get taxed on the 600,000.
Yeah, so you can back out the 500, you can back out any improvements, but in this example, I said, okay, they had 200,000 in depreciation. Well, that's lowering their tax basis. So if you start at $500,000 tax basis and you took 200,000 in depreciation, your tax basis now is only 300,000. So some, hold their properties for 20, 25, 30 years. And in that case, they've actually depreciated the whole thing. So anybody that comes to me and says, oh, yeah, I've had this property, it's been in our family for 30 years, they pretty much don't have any basis. The whole thing, this whole 950 would be taxable. Yeah, it's amazing. So the longer somebody has a property, the more gain they're going to have in it. And it's it's an important part to remember because remember I said IRS will want 25% of this depreciation. So let's say they had no appreciation during this time, they would still owe, the depreciation recapture. So it creates a challenge, and I put a couple things just to show it. So what if somebody was selling, they think they have $200,000 in profit, and they turn around and file their taxes next year? Well, again, they could find out that they owe, 60 to 80,000 in tax, right? And so hopefully they'd hold on to that cash because again, they're adding up all those layers. Larger properties, or if they've depreciated it for a while, let's say somebody thinks they're going to have a $2 million profit. Again, that can easily get lowered by up to 800,000. And I had a client about a year or two ago that had a very similar situation. We did an exchange for him, and he emailed me around tax time as he was, sending everything into a CPA. And he was saying, oh, you guys saved me so much. I'm so glad. He goes, I wish I would have known about this 2 years ago. And I asked him, I was like, well, what happened 2 years ago? Well, he had sold a property for 1.8 million, and they'd had it for 20 years. It was an investment property. The following year, he reported his tax return, and he owed 600,000 on it. So sold for 1.8, had to pay 600,000 of that to the IRS. And again, he says, I wish I would have known. So it's one of those 1 out of 6, one of those 5 or 6 that didn't exchange, and cost them a ton of money. So that's the why. That's why this is so important. How do we get rid of all that? There's 2 basic rules. If you want to defer 100% of all that, you buy property of equal or greater value than the net selling price of the relinquished, okay? And then reinvest all the cash and all the equity received from the sale. So you do those 2 things, that's going to defer 100% of all that we just went through. You wouldn't pay 1 cent of tax. Net selling price, what does that mean? So again, I just set this up real quick. And we saw this on the last slide. Somebody's selling for $1 million, 50,000 in closing costs. That's allowable costs, like, again, commissions, title, closing fee. This is their net price. So in this example, 950,000 is what they want to buy. Now, it can be one property, it can be several, but the total, they'd want to hit 950. That would be for 100% deferral.
Yeah, I don't know if you talk about it later in your slides, but if not, maybe here's a good time. If you happen to have a mortgage on the property you're selling, you want to just chat about that?
Yeah, let's talk about mortgage. Good segue to my next slide. So, yeah, it's like a mind reader. Yeah. So, okay, so same scenario. So we sold for $1 million, 50,000 in closing costs, 950. Now the same property now has 500,000 in a mortgage. So they're expecting to pocket 450,000. So they got to hit. Now, according to those 2 rules, if they don't want to pay any tax, they need to buy a property or properties worth 950,000, and this 450,000 needs to go into that property. So what does that mean they have to do to hit the 950? Is they are probably going to need another loan for 500,000. I say probably because if they have their own cash that they'd rather put into it so that they have a free and clear property, that's totally fine. So it's one or the other. And I mention that because that is a rule that's read in the IRS guidelines regarding 1031s. They'll say you need to match your debt. So if you have $500,000 loan, you need a $500,000 loan. But this is why it's wrapped up into those 2 rules. If you're replacing what you sold, you need to replace 500,000. Most of the time, it's going to come out of the loan. But if somebody has cash, that is fine. With that, now on my remember on the other slide, I was showing what capital gains is. And I was showing that somebody might have 600,000 in capital gains in this scenario. And when I show all the tax, 30 to 40%, they could be owing, 240,000 or so of that tax if that's the case. So it just puts that reality again. So somebody might be getting 450,000 equity thinking, hey, I'm just going to pay a few $1,000 and cash out, but they might easily be sending half of this to the IRS. And so it's so important to know that those numbers once, when someone starts thinking of selling investment property, so they can plan accordingly. They don't want to be surprised next year and realize that, oh, I spent all this money and I owe the IRS all this money. Okay, so that's that. Now, what can be exchanged? The other thing that you're going to find when you Google 1031 exchanges, or if you look it up online at all, is there's this term that's always going to be used and thrown around called like-kind exchange. And the IRS uses it, it's used all over the place, and that confuses the heck out of people because what's going to happen a lot of times is, and I hear this, someone is selling a duplex and they'll tell me, well, I'm selling this duplex for 2 million and I don't think I'm going to find another duplex in the same price range, so I guess I'm just going to have to cash out, pay the tax. And so they're confusing like kind to mean exact same property type. And that's not the case. So with 1031, again, we're talking about the sale of investment property and replacing it with other investment property. That's all it's talking about. Within that investment property, it can be any type, as long as it's real property. So in the past, people could sell jewelry or airplanes and other things and do an exchange, not pay tax on any gain. That's all things of the past. But now any real property can be exchanged. And so just an example of this, so they have raw land, any vacant land, it's not having any cash flow, they can sell 1031 it into any other property. I have a client that did this a couple of years ago. They sold some family farmland in Illinois. Hadn't been used much recently. They sold it for around $1 million, and they bought 3 single family rentals, and they were all spread out in different states. They had renters built in, management, everything built in. It was kind of like a package thing. So they took land that was not producing and now have 3 producing properties. And you can do it vice versa. You can sell or buy land in a 1031 exchange. Of course, commercial is fine, and you can go in between. So if someone has single family, they want to get into commercial, or they have commercial and they want to go back, totally fine. Any mixing and matching of any of these.
Yeah, to
I
Aaron's
even put
point,
at the,
we sold the
yep.
single family and went into industrial, so they're mixing
Oh,
that.
yeah. You're a perfect example of that. That's right. Yeah, you were mentioning your triple net lease properties, and that's commercial real estate, 30-year leases. People with cell tower leases. We do those exchanges. They're thinking, well, we don't know the land, but if the lease is over 30 years, that's considered real property. And so those can be exchanged. Somebody that's selling properties and they don't want to manage anything. They just don't want property anymore. We're seeing that a lot. A lot of people are retiring and just wanting to dispose of their real estate portfolio. They can go into passive income, like down here at the bottom. This says Delaware Statutory Trust. DST is the acronym. Basically, it's pieces of ownership in large commercial projects, but it's passive income. That's a lot because of the structure. It's allowed in a 1031 exchange. Oil and mineral rights. So there are passive income opportunities, but it's just a matter of knowing and researching so that somebody doesn't sell and send it all to the IRS and not realizing, oh, I could have invested that into myself. So that is the what can be exchanged, which basically again is any real property as long as it's investment property. So property that's that you're selling has been quote unquote held for investment, and property that you're buying is going to be quote unquote held for investment that you're planning to hold for investment. That's all fine. Now, the next question I get then is, well, okay, what if I don't want to buy a property worth as much as I sold? Maybe they don't want to, a loan for that amount anymore, or they wanted to pay off some bills that they had. So I have these discussions all the time. What they're really asking is, can I buy less property? Do I have to buy exactly? Can I buy less? And the answer is yes, you can buy less than what you sold. That's called a partial exchange. And you could still get some benefit. Your tax will be owed on the difference. Why did I say it may provide some benefit? Remember, I showed you're going to have a tax basis, and then anything above that is gain. So you at least got to be replacing your basis and replacing some of that gain to subtract out some of the tax that you would normally be having. But if you sell for $1 million and you only buy for 800 or 900,000, you're going to pay tax on that little bit of difference in there. But you think about it in terms of that client I told you about that he sold for 1.8 and he had to pay 600,000. Now, what if he had bought for, maybe he needed some cash to pay off some bills. So what if he bought something for 1.3 or 1.4? No, instead of a $600,000 bill, he would have had maybe 150,000 or something like that, and he could have kept the rest of everything in real estate, all that equity compounding for himself. So so partial exchanges, I'm seeing these a lot more often over the last couple of years because of the market we've been in, right? It's changed, a lot of things what people are trying to do, and this has been one of them. A lot of it's because they might be sitting on a 3% rate and they don't want to buy, get another $500,000 loan at 7%. And, it's understandable, even though I remind them, hey, that's going to all be covered, that's going to be covered by the payment, right? And it's tax deductible and you won't have to pay hundreds of thousands in tax. But, if they're trying to do it without a loan, they can do a partial. Okay, so all these different reasons to exchange. So what I see, of course, so most of the time people are diversifying and trying to build their portfolio. So selling one property and buying two or three, or sometimes four and five. They might sell in one state with higher equity and buy five in other states. I see it all the time. So that's very common. Also, you can consolidate, you can go the other way. So some that have multiple properties and now want to put it into one. Maybe they're trying to now get into larger assets like apartment buildings, totally fine. Or they just don't want to manage anymore and they want to put into one Airbnb property. That's fine. So in that case, as long as the one that they're buying equals all the ones that they sold, totally fine. It might just be relocation, finding new areas. Maybe they've depreciated everything. They want to buy higher, property and have more to depreciate. And again, there's passive income options as well. So all these different reasons. I will mention too, as far as this consolidation, just one little tip. Sometimes, again, if somebody's thinking, I don't want to be in real estate anymore and they're selling, I throw out there, hey, if you haven't found your dream retirement home, maybe look for that, exchange into it. Now, it's supposed to be investment property, right? So what you'd have to do is rent it for the first 2 years, show it on your tax return as a rental for 2 years. Then if you need to move into it, so be it. The courts have shown that's been fine. Just the intent when you buy it has to be investment property. So there's all these different things, just depending on what somebody's really trying to achieve. Just reach out and we can see if there's a way of making it happen. Now, how does somebody get cash then? So here's the thing: they're thinking, well, yeah, I'm getting all this new property, but how do I ever get to use it? How do I ever get to use the money? So there's two things. So I talked one about doing a partial exchange. So when you sell, you can say, hey, I need 100,000 for whatever purpose. Take that out of the sale. And now you're going to pay tax just on that portion. And then you can exchange the rest, right? So you're just going to pay a smaller part of tax on that, but keep everything else going. What I feel the ideal way, if you want to do it all tax-free, is exchange the whole thing, put it all into a new property, and then later on take a cash out refi out of that property. It's just like any other, cash out refi. You're not paying tax on mortgage proceeds. So there's ways of accessing cash, but keeping it all going is the main thing. The importance of keep it all compounding is I'm going to show here on this chart. And it's just simple math, this table. All I'm showing is investor A in the middle column, investor B. Investor A is going to sell and do exchanges. Investor B is going to pay the tax. And I started them both at 100,000 in equity. They're each going to sell every time they hit 50%. And I just said, this guy, investor B, is going to pay 30% every time. Now, there's no limit to the amount of times they can keep doing this. So it's not like you exchange once and now you're done. You can keep on doing this for a lifetime. So let's say they started at 100,000, right? After 10 times, the guy that's not paying any tax, he's up to 5.7. Again, this is just straight math. That's all. The one that's been paying taxes along the way, he's only at little over 2 million, basically. So a $3.7 million difference. And that's just from starting from scratch. Now, if you just keep running it out, now 10 times got him to 5 million. What would 10 more times get him to? He would go from 5 all the way to 330 million. And whereas the other guy is only going to be now at 40, $290 million difference. Why is that? It's because of compounding. That's the power of compounding and letting things continue to build without withdrawing from it and setting it back, such as a large tax bill that takes away all of your equity and all your compounding. There are large owners of real estate portfolios. One in Florida in particular, I listened to his podcast. He owns about 300 million in properties. And he said in his podcast, the only reason that happened was because of the 1031 exchange. That's 100% why he's sitting at 300 million. Because he had put money into the property, he would fix them up, get more appreciation, refinance them, pull the money back out, and then sell and 1031 him into more property. He just kept doing it over and over. So what's the next question that's going to happen from that now? So I talked to, let's say I'm consulting, somebody's thinking about this. One of the things I hear is, well, here's the thing. I'm going to have to pay this at some point, right? I'm going to have to pay all this tax. And in the future, won't tax rates be higher, right? So that's a question that comes up. I get that from brokers a lot too, by the way. So I get this from a lot of different ones. So if you're asking it, don't think you're the only one. But here's the thing that now that that's being left out of the equation. I said you can keep doing this for a lifetime. So the idea here is to never sell without doing an exchange in some way, shape, or form, whether it's a full or partial. Because when you pass on and your real estate goes to your heirs, they get what's called a step up in basis of their value. So this is called swap till you drop. That's the very technical term in the industry. Never sell without exchanging. Keep on swapping because your heirs will get the step up in basis, right? So I was showing earlier with somebody with 600,000 in capital gain in that property. Well, guess what? If they passed it on to their heirs tomorrow, there's not any gain when they receive it. It all went away. So there might be some estate taxes, depending on how large the estate is, but all that capital gains went away. And that goes back to how wealthy families have been passing on, generational wealth. A large chunk of it is real estate and 1031 exchanging and not paying the tax bills. That's how that is happening. Okay, so I already went through this, more reasons to exchange. Okay, so that's the overall view of exchanging, why it's important, and then I'll get into just a couple little fine-tuned things as I go. But first, I thought I'd do a quick review, make sure everyone's still with me, because it seems like a lot, but really we put together what's called we call it the 5 commandments. If you understand these 5 principles, it's going to cover 96-97% of circumstances. So number one, we're talking about in business or investment property, okay, not primary residence. Although that gets into another thing. If they're renting part of it, maybe they have like a mother-in-law quarter, they're renting a portion of their property, that could be exchanged. Any investment portion can be exchanged. Or can somebody move out of an investment property, turn it into, out of their primary residence, turn it into an investment property, for a year or two and then sell it? Yes, yeah. And they might still get their primary residence exclusion, by the way, which is $250 for a single person, $500,000 for a couple. They can take that off the table and exchange the rest. Okay, so that gets into a lot of other strategies, right? But overall, the exchange portion that they're doing has to be investment property. That's the bottom line. Okay, on either one of these. Commandment 2, remember to not pay tax by equal or greater value of what you sold and invest all the cash and equity received. Okay, those two things will defer 100%. You can do less, that'll be a partial, you will have some tax. Number 3, remember day 45, the identification list is due if you haven't closed on anything yet. You know, nothing wrong with lining it up and closing right away, but by day 45, you need to turn in a list. And then number 4 is you have to close on property within 180 days. And number 5, remember you do need to use a qualified intermediary like us. So that just means somebody that represents you in the transaction. Your CPA can't be your intermediary, your broker can't, financial planner can't, your attorney can't. That's what we're here for. That's what specifically for that purpose. So if you know those 5 things, you're going to cover a lot, again, about 96% of the transactions that you'll be doing. What about the reverse exchange? I think I have maybe a few minutes. I can tap into a couple little finer areas and then, you know, take any questions that you maybe been thinking about. So I mentioned the reverse exchange is a way to identify property first and buy it. So that way you don't pass it up. Okay. So now this day 0 becomes the closing date of the purchase property. All right. And then you have 180 days to sell your property. I put 45 here to identify which one you're going to sell. Usually in reverse, they already know. We're going to buy this one, then I'm going to turn around and sell this one. But if you have several and you're not sure, you'd have to identify by day 45. Okay, so you're buying first. How does this happen? It sounds simple, but first of all, you need a way to purchase it. And here's the thing, though. You can't just go out and buy it in your name because you can't own both properties at the same time. Because when you go to sell, well, what's the exchange? You already own both properties. So what's going on with the reverse, it's real interesting, is there's a new entity being set up, and it's this EAT, EAT, Exchange Accommodation Title Holder. This is being set up where we, as the qualified intermediary, are the sole member of the LLC, this EAT, and the exchanger is the manager of it. But that puts us really in possession of it. This is what we call parking the property in the EAT, so that they don't technically own it, but for 1031 purposes, they're the manager of it. There's lease agreements done and all these different, you know, agreements done where they can run it and control the property, but we're owning it during the time of the exchange. Because of this, there's a little bit more time involved and a little bit more cost because of the setup, the liability. It can take a couple of weeks. Realistically, once we have everything, it can be set up in like a day or two. It goes pretty quick. But of course, collecting everything that we need is the issue. So I just tell people, hey, it's going to take a couple of weeks. But this is the crux of it. So because of that structure, if somebody's going to need a loan to buy that property, how are lenders going to look at that? And I focused in on this, as you might guess. I mentioned I have the lending background of almost 30 years. And if it's a residential property, right? So you're a buyer, you've been pre-approved for a mortgage, and you're thinking, hey, I could just go buy a property as a reverse exchange, and then I can sell later. Well, keep in mind what I just mentioned on the structure is we're going to be the ones holding it, though, in this new entity. Is a lender going to like that? The answer is no, they don't like it, and they won't do it. Not in a conventional loan by any means. So if financing is needed, it's going to have to be private money, bridge loan from a lender that has done a reverse exchange before. So I always ask that question first when someone asks about a reverse exchange is, do you have cash? Are you able to buy it? You know, and the knowing you'll get reimbursed when you sell, or do you really need to sell that property? Because if so, you're going to need like some sort of bridge loan with a lender that understands what's going on. Okay, if it's a commercial property, a lot of the commercial lenders and banks, are familiar, and that's a little different story. They usually can handle the setup. Then what'll happen is, so they've bought the property. What happens if now they try selling and they go 180 days and they haven't sold? They ask me that, and that has happened a lot, by the way. I tell them, well, first of all, maybe when you put it on the market, let's price it right. But if you get to 180 days, your exchange is over. Nothing has been sold, right? So there's no tax hit. That's the good news. You own two properties. That entity that was set up to park it now is just going to get assigned over, and you own two properties. That's it. Now, if they still are going to be selling, they can do a forward exchange. So they say, well, I'm going to sell this property still. Then what do I do with it? Well, you can exchange it into something, or even into a DST, maybe get some passive income if you don't want another property. So you still have that opportunity to not pay tax. In other words, it may not have been what you were planning on, but there's still that opportunity. One of my clients that happened to, it was one that he called me. He had some properties on Kauai, and he was, Googling and reading, and he says, I think I can do this thing called a reverse. He says, I bought a property 2 months ago, and I had to tell him, wait a minute, you already bought it? It's too late. You can't do a reverse. But the property you're planning to sell now, you can definitely still do an exchange, and that's what he did. Okay, so that's a reverse. The other thing I just wanted to bring out was regarding ownership, because sometimes, especially when you get into commercial projects, ownership can get a little complex, right? Because somebody might be, in order to get capital, they're raising capital, they're going in with partners and different things, and then they want to set up all these different entities, and then they want to sell this one and this entity, and now buy in this other partnership they're setting up. So that's why I thought I'd address this, just so at least any newer investors, even seasoned ones, kind of forget this too, and I can just review what happens. The thing to consider, what we're doing here is the 1031 is so that the taxpayer that's selling doesn't have to report that on their tax return and pay the tax. So what does that mean? It means the taxpayer that's selling has to be the same taxpayer that's going to be buying. Now that taxpayer can be entities. It can, whoever actually owns the property. So they might hold it in a corporation, general partnership, LLCs, trusts. Whatever owns that property needs to be the one that's going to be buying the replacement property. Okay. In that way, when they go to file the tax return, the IRS, it's very obvious. Oh, yeah. Okay. They did an exchange, same taxpayer, all makes sense. I put a note here. There is a note for disregarded entities. What often happens, let's say I, as an individual, just bought an investment property, but I want to make sure it's protected from a lawsuit. So I set up a new LLC just to hold title. And what happens is that LLC, that's the sole purpose. It's just as a protection, but that LLC isn't paying taxes. It still reports to me as a person. That's called a disregarded entity for tax purposes. In that case, it's fine for somebody to sell, let's say, in a personal name and buy in an LLC if that's a disregarded entity that's buying.
Yeah, actually,
So I'm just going to
we did
mention
that,
that.
and there was a big discussion about the name of it. So disregarded entity, our accountant said it was for the sole member, but if it's a husband, wife, and I'm not sure in community property states, but they call it a pass-through entity
Pass through,
here,
yeah.
yeah, in New Jersey.
Yep, exactly. And sometimes it's even falls under another entity. They're like, well, it's held in this LLC, but it's under this S corp. But that's the thing. Yeah, the taxes are being passed on to somewhere else. So in that case, as long as that's considered the same taxpayer,
Right.
it's going to
And
be
that
okay.
was the other thing. Like we had held our single family in our own name, so we weren't sure if we could create an LLC for the replacement property, and that's where all
Mhm.
this discussion started. But
Yeah,
ended up we can, we could.
yeah.
Like, when we opened our LLC, it was a government shutdown, so it took a bit to get that done.
Oh, wow. Yeah, exactly. Yeah, no, there's always, as if the 1031 isn't, have issues enough. Yeah, there can definitely be outside forces at the wrong time. But yeah, that's right. So with your situation, yeah, that worked out. And yeah, so we get asked that a lot. Sometimes somebody will own three different properties and they name each LLC like this is Main Street LLC, this one's Oak Street LLC. So they have like these three. Now they're going to sell them and exchange them, but they don't want the new property to be, it's not on Main Street anymore. So that's what we'll tell them. Yeah, you can set up another LLC, another disregarded entity or a new pastor entity called, whatever. Now it's, Oak Street, LLC, and you can use that to buy it. That's fine. Or they can just complete the purchase and then transfer it into the new LLC after. Either way. But where this gets a little complex is for those times when someone actually, that LLC is a multi-member LLC. And it could be, for instance, siblings inherited a property, two or three of them. And they're like, hey, let's go form this LLC together. It's going to hold title. So there's three people owning an LLC. Now that's a multi-member LLC. That's not disregarded. Or it could be somebody getting their friend, hey, let's raise some cash and we'll go buy this property. Now they have a partnership. Well, what happens is all partnerships usually come to an end at some point. So it's a great way to get into property, but they forget about the exit and how what's going to happen, because what happens, everyone's to go different directions at some point. Hey, we're selling for $1 million. There's three of us. Awesome. We're all going to get 300,000. I want to exchange my 300,000. They want to cash out. But guess what? They're in an entity. That entity is the owner. They're not. And so this comes up a lot that we have to explain. So when one person wants to exchange and the others are wanting to cash out, we have to check how title is held, remembering that the taxpayer has to stay the same. If it's in a multi-member LLC, that LLC is the taxpayer, and that LLC would have to do the exchange. And if they broke it up and all held title is what's called tenants in common, that's how they can all do what they want. Perfect. Just today, before I got on this class with you guys, I was just talking with a new client where they're selling an apartment building. Oh, there's 5 siblings on it, and that was one of my first questions. Okay, let's go back first of all how title is held, because she was already going off into replacement properties and so I'm like, wait, there's 5 of you holding this. Did you all set up an LLC? She looked it up. Fortunately, guess what? They all said like so-and-so, personal name, 1/5 interest. Another person, 1/5 interest. Guess what? Each one of them can sell. They have 20% each. Their 20%, each one can either exchange or cash out. That's how that's done on title. If they have a multi-member LLC and they want to change it, they have to do this gets a little deeper, but just so they know, and again, I know a lot of investors are going to be setting things up and not realizing some of this. They can do what's called a drop and swap, so they'd have to drop out of their LLC and take title as tenants in common. Now that could get complex. We always tell them make sure you're talking with your CPA and any lawyers, because what's your tax, tax issue? How's your LLC set up? Is there a loan on the property? Will that mess up? Will the lender not like that? Right. So there's some considerations. Also, the other thing with doing this is on timing, is if you're doing it at the last minute, because again, we get calls once they're under contract, right? And they're saying, I'm going to exchange, my partner doesn't want to exchange. If they try to switch it at the last minute, the IRS could possibly look back at that and say, hey, you did that only with the purpose of avoiding tax. And guess what? We're still going to charge it to you. So that's usually has to be done, maybe 12 months ahead of time. It's interesting, though, on this, there was a court case in New York last year where New York State allowed a last minute drop and swap. They said they consider that as fine. And so for those in New York, it sounds like it opened up a whole new world of drop and swaps. But we still tell people, get legal advice. The opposite way of that is a swap and drop. So go ahead, you have a multi-member LLC, go ahead and have the LLC buy the replacement property that the one member wants. but then they got to figure out how to drop out of that and buy out the other members after. Um, and so, for instance, if they have a loan on the property, and if they were going to drop them all out to ticks, and the lender doesn't like it, maybe they got to go ahead and do this swap first and then drop it out. So it's just there's these different things we got to think about when there's multiple, when there's partnerships or multi-member entities on title, and they all want to go different directions, right? That's something to think about. There's even another option of doing a note buyout of the partner that doesn't want to exchange. So there's these different complex mechanisms, but it has to be thought about in advance. That's why the consulting needs to begin, even well before getting under contract, just so we can review some of these issues that might come up. Okay, so that got kind of deep there for a couple minutes, but I just want to at least call people's attention to it. We have some tools that can help everyone through their exchange journey. We built a 1031 exchange calculator. So if somebody wants to really get in the weeds and punch in all their numbers, it's like this Excel sheet, but it's very easy to use. We have an ebook that can be downloaded. We built a 1031 AI. So right on our website, where it looks like a chat box, it's actually an AI that's been fed just all the IRS regulations, court cases, and so forth. So you can ask it all these kind of questions about title and whatnot, and it can pull it up from the sources. We built a 1031 hotline off of that. So if somebody doesn't want to type it all in, they'd rather just ask and have somebody say it back to them based on all the AI information. We have a hotline that we call it AI Aaron because it's going to sound a lot like me when you hear it. It can reply to you in Spanish and in Mandarin, by the way, too. So you just tell it what you need. Free consultations are by far and away the most needed and best used. So again, any questions, anytime someone's thinking through these things, hey, in a few months we might sell, thinking about this, let us consult and kind of go through this scenario.
Did they get these on the website or some other way?
I'm sorry, what was that? Oh, for the information, yeah. This is all on our website.
I'll put 1031.
If they can't find it, on our 1031 specialist website, so www.1031specialist.com. I can always send it to someone too. So if they just want to reach out to me, say, hey, can you send me the calculator? I can send them the link because it's like a link they get and then they download it. So I can always send stuff too as needed. One last thing I want to just mention is protection of funds. I mentioned that the investor can't touch the funds. It has to come to us. So we're setting up an account to hold them in. We've set the gold standard on fund protection because not only our first job is to make sure they're not paying tax, but we got to make sure the funds are there to go to your replacement property or that they're getting to the replacement, they're getting to the right spot. There's cyber fraud, there's all this other stuff. Mm-hmm. And so first off is setting up this segregated account. So we set up a bank account, but number two is qualified escrow agreement. That is key because what that is, it's a three-way agreement. Nobody can unilaterally move those funds without everyone's agreement. That's you as the investor, that's us, that's the bank. And by the way, when I say us, it requires two signatures at the company. So in other words, you can't just say, hey, we set up the segregated account, we put everybody's money into the same one, and then we move half, $50 million somewhere else, right? That just cannot happen because of the way we set everything up. E&O insurance and bonding, of course, that's industry standard. We have that. But again, you don't want to rely on insurance to get your money back if it's sent to the wrong place. So this last one, we're the only QI that's bought into this verification. It's a real-time bank alert system. Basically, when you're going on doing bill pay online and stuff, you feel pretty safe. Well, they have this whole system connected to, with all the banks and routing numbers. And we've bought into that. So we can verify verbally all the wire instructions of where it's going. But before sending it off, we run it through the system. And if it looks fraudulent, or if we just made an error, we punch it in wrong, it's going to give the alert before it's sent off. So we want to make sure this is by far and away the gold standard of how funds should be handled. And we're the only ones that set it up this way. Okay, you already mentioned how we're backed by NAR with the REACH program, so that's just a pretty cool thing. Yeah, and that's what's allowed me to be on the NAR Realtor Store. I have a recorded webinar on there, speak at their conferences. And again, here's my information. So this is our website, the 1031specialist.com. My email, this is my direct line, by the way. Come right to me, and you can text on it. And if you want to scan the QR code, you can save it into your phone and reach out anytime. And yeah, happy to go through any questions, whether it's now or after, but let me stop sharing.
First, thank you for that great information.
Yes, very good, very good.
So I do have a question about oil and gas. How does that considered like kind? I was a little puzzled. And how do you value that? Like an exchange from a single family to oil and gas, for example.
Yeah, there's the way, well, it's the way the investments are set up. So it's in, where you're getting from a particular piece of real estate, where that investment is coming from, where you're getting the gas. So it's the same with the DST. It's you're getting a percentage of a particular project so each one of those, it's how they're set up to where you're getting, even if it's 0.012% of ownership in it, that's considered ownership. And the difference, I'd say, is because the questions we always get is what about a REIT, right? A real estate investment trust, which is basically a mutual fund of many projects, but there's no ownership. If you buy into that, you're getting shares, and the shares can go up and down based on how they perform, but you don't have ownership. You can't 1031 into a REIT. So anything, if the investment is set up to where you have ownership, and so that's how a lot of the oil and gas, there's a whole marketplace specifically for 1031 exchangers that you can, they can show you what projects they have and go into them. Same with DSTs. There's even ones where, because a lot of people, when they go into projects like with syndications, but again, syndications have their own entity set up. You're not getting real estate usually, but there's similar projects and there's marketplaces where they need TIC. It's called a TIC marketplace, TIC, the tenant in common, where they're bringing everybody in as tenants in common. That's specifically done for 1031 exchanges. So anything giving you ownership is allowable.
Oh, interesting. Can you put your QR code up again, please?
Oh yeah. Let me share again here. Hold on just a second. All right, is that up for you?
There you go.
Okay.
I got a couple questions for you.
Yeah.
Now, in regards to the ranch or farm, does it have to be like you lease it out to somebody, or how does that work?
As long as you're talking about selling a farm, but
No,
you're
no.
going to
If I
1031
were to buy,
exchange into
sell a
something else.
single family house and go buy it said a ranch or a farm.
Yeah. So yeah, that because usually that's business purpose, right? So if you're buying a ranch or a farm, that's some business that's on your property that can be done. If you're gonna live in part of it, then you just have to delineate what percentage is primary residence and what percentage what of the value is business purpose. Because you have to replace what you sold, right? So as long as the percentage that's investment is
Mhm.
replacing what you sold, you're okay. An example here where I'm at, there's a lot of properties in this high-end area called Rancho Santa Fe, and a lot of them have horses. I was just talking with a realtor yesterday where someone's selling multi-million dollar estate, and they live on it. They have they call it like a casita unit, like a some sort of like ADU, and they've been doing this equestrian business. So we're going through that with them. Well, wait a minute. Part of it is investment property. Now you have to determine in that case how much, of your $12 million property is used for investment purposes. But whatever that is, that part can be exchanged so you don't pay tax and all that. So it's the same with farm and ranch. It's the same idea.
Okay. And my next one is, can you actually sell your primary residence and move into a rental, say that you've owned for 20 years, and turn that into your primary residence and get the capital gains off your primary residence? Now you're making one of the rentals, single family, your primary residence, and repeat that, because you were saying you have to live in it for 2 years. Could you keep repeating that to unload uh your single family houses if you wanted to
Yeah,
and pay?
the 2 year thing, that's under what it's called Section 121. That's the primary residence exclusion. And there's nothing anyone has to do for that as long as they lived in the property any 2 years out of the past 5 years. Okay. Um, when they sell, they report it on their tax return. They report the sale, then it'll ask, did you live in this 2 out of the past 5 years? Yes. Guess what? You just qualified for the primary. There's nothing else you have to do. You get that primary residence exclusion. Yes, you can repeat that every 2 years.
So
Um,
how would you convert the rental into a primary residence? Just by moving in it?
by moving in it. Now, in that case, uh, there's going to be the CPA will have to factor how much time it was a rental compared to how much time they lived in it to do like a ratio of how much of that exclusion they're going to get. Um, so their CPA is going to have to get involved to see how, but yes, to convert it, you're just going to move into it.
Mhm.
Now, it's not currently an investment property at that point anymore, so you can't 1031 it. Usually, what I'm dealing with is the reverse. Somebody's living in a property, they got a ton of equity in it, and if they sell it, um, they won't have enough. Maybe they're single and they have a $250,000 exclusion, but they have a lot more equity than that. Well, if they
Mhm.
move out of it and convert it to an investment property, they start renting it, right? Then when they sell it, now it's a rental property. They can 1031 it, but they still didn't lose that primary exclusion as long as they lived in it any 2 out of the past 5. So
To
there's a
sell it
chance
within
that
the five
they can
years.
combine it. Yeah, yeah, they have to sell it before that. Yeah, so once they move out, they basically have 3 years to sell, right? They want to at least be renting it 1 to 2 years to show it clearly as an investment property. Sell it by year 3 because now their 5 years is up. 2 years of living in it, 3 years of being out of it.
Interesting.
Okay.
Yep.
Mhm.
So those take a little planning. Obviously, most aren't going to be thinking that far in advance, but there we are. I just finished one just like that. And sometimes it's not intentional. Maybe they moved out of it and then they started thinking about it. Like, wait a minute, I lived in that, and now I'm renting it. What can I do? So we get to explain some of their options.
Okay, thank
Let's
you.
see who has
Yeah.
questions. Anyone here have questions besides putting up the QR code? Dale, I'm going to call on you. You there?
I'm here, Donna, but nothing from me. My head is spinning, although I was familiar with some of this. But thanks for all of the information, Aaron.
Yeah, you're welcome. Yeah. And I know it's a whole lot. That's why I usually try to stick to some of the basics first. But yeah, at least expose you to a lot of things, and maybe you'll remember, if something comes up, just feel free to reach out.
Thank you. Yeah, actually, this was really good because I was researching a 1031 exchange probably about a couple of months ago and decided that I was not in a position to do a 1031 based on some of the things that you said. So I feel really good that I
Yeah.
interpreted what I read pretty accurately. So there's that.
Well done.
But
Well done.
right, the multiple exposures I think is what's really useful for people to learn, obviously. So yeah, this was great to have it right on the heels of it to kind of set it up.
Right, and the
Yeah.
replay will be up within about a week, so you'll be able to watch it over and over and over again when you're ready. Or just call Aaron, and that's what I did.
Right. That too.
Exactly.
All right, Dale, do you have any questions? I'm sorry, not Dale, David. No, here. All right, we'll go down the list. Gabby? Nobody's picking up. Hi, Gabby, how are you?
Hey, thank you for this, Donna, and thank you for the information too, Aaron. I think my biggest question is, and I think Ken kind of like insert a little, ask it a little bit, but I'm still not quite sure if I've lived in a property for a number of years, and then I'm planning on moving out. Is that something I can still use that information for?
Mhm. Yeah, so what we were mentioning there, Gabby, is if you move out, so you're living in it now and you move out, are you going to start renting it? Is that kind of the plan?
Yes.
Yeah.
Yes.
Okay. So you rent it for, 1 to 2 years, and then let's say you start thinking of selling. Well, if you sell it by then before the end of the third year, and you think back now, you still lived in it 2 out of the past 5, because by the time you get back to 5 years ago at that point, you were still in it for 2 years. But then now it's been rented for a couple years. So now it's technically currently an investment property. Um, what can happen there is when you sell it, you can still take your primary exclusion. That's the section 121. You can take that first. That's tax free right off the table at closing. And then if you still have more equity beyond that you normally would have to pay tax on, you could exchange the rest of that and put that into other investment property. So that's how the two can get it combined and have the power of both tax laws.
Thank you. That's very helpful.
Yeah, you're welcome.
I know we're running out of time. Just real quick, anyone? Nigel, Rakshanda, Patricia, Madison?
I'm good. It was pretty
I
much
actually have another
self-explanatory,
one too, if nobody else does.
but I appreciate the information. It was really helpful.
Thank you, Nigel. Okay, Ken has one more question and then we'll wrap it up.
Yeah. Okay. Now, can you actually sell a rental and buy raw land with it and then sell the
Yes.
raw lands in parcels?
Yes. Yeah, you can do that. Yeah. So that's the great thing with land, whether you're selling it or whether you're going to be buying it as part of an exchange, that is allowable.
Now, do you have to sell the land in a certain period of time, or can you hold it till you feel like selling it? Like if you buy like whatever, 100 acres and you don't feel like selling the whole 100 acres, but someone comes and offers you or wants to buy 20 acres off of you. Can
Mhm.
you sell that and still keep the rest, or is there a certain time
Oh,
frame where you
sure.
actually have to sell the land?
Yeah. Yeah. No, so anytime you sell, you can do a 1031. Um, in that particular case, you're talking about selling part of it. So, you just, again, you're tracking how much you're selling compared to how much you got to buy and what your tax basis was before. So you just got to track the numbers a little bit. But for that section you're selling, whatever gain is on that section, yes, absolutely, that can be 1031.
Yeah, okay. Thank
Yeah,
you.
sure.
Time just goes so fast over here, but Aaron, thank you so much for all you shared.
Terrific.
Loved having you
Yes.
here. It's great information. We thank everyone for joining us tonight. And as I mentioned, we'll have a replay up. I'll share the links with all of you. And thanks again. Any last minute points you want to make, Aaron? before we wrap
No,
up?
I covered a lot. I know, like you said, time going by fast. I did a lot of talking. But again, just do not hesitate to reach out with any questions. Even if somebody's thinking of a possible thing in 12 months and they're just not clear, that's fine. Feel free to reach out anyway. I'm always happy to help.
All right.
Thank you.
Well, thank you again. It's been wonderful. Appreciate
Thank
You're
you.
welcome.
Thank you.
Thanks for having me on. I appreciate it, guys.
Yes.
Have a great night.
it.
Yes, you too. Thank you.
Bye-bye.
Right. Goodbye.